It's strong, but a little softer than it was 6 months ago. But that's over a broad range of business. You look at car loadings, rail car loadings, that's moving goods around. And there again, that was affected by the tariffs too, because people front-ended purchases, all kinds of things, always a lot of variables. But business is down, but it's down from a very good level. So I would say that looking at our 70 businesses, and that actually, they represent hundreds in addition, they're a little softer. On the other hand, I was out with the fellows from the Nebraska Furniture Mart just Saturday night, and their business was up quite a bit in February, but that's because weather was good. So you have a lot of variables that hit. Well, it isn't really down. It's just it leveled off and a little softer maybe now. But, well, tariffs, the tariff situation was a big question mark for all kinds of companies, and still is to some degree. But that was front and center for a while. Now coronavirus is front and center. Something else will be front and center 6 months from now, and a year from now, and 2 years from now. The real question is where are these businesses going to be 5 and 10 and 20 years from now? Some of them will do sensationally. Some of them will disappear. And overall, I think America will do very well. It has since 1776. Certain businesses depend on weather to quite an extent in retail, for example, in given months. But the big trends you see are going on. I mean, in terms of the movement to online commerce, and I mean, the big stuff keeps moving. But we've got a big investment in the airline business, and I just heard, even more flights are canceled and all that. But flights are canceled for weather. It so happens in this case they're going to be canceled for longer because of coronavirus. But if you own airlines for 10 or 20 years, you're going to have some ups and downs in current business, and some of them will be weather related, and they can be all kinds of things. The real question is how many passengers are they going to be carrying 10 years from now and 15 years from now, and what will margins be, and what will the competitive position be? And, well,
right.
Our largest position is in Delta. 3 of the 4 positions are mine. 1 of the positions is one of the other fellows of the 4 positions. But we own a very roughly close to 10% of the 4 largest airlines. With Delta, we own 18% of American Express, and American Express is a bank holding company, and bank holding companies have limits as to what they can do, and we're a passive holder of a bank holding company with American Express. But then if we owned an airline that was tied up with them, they'd have lots of arrangements. There's a lot of complications because it's a regulated industry. Anytime you get in a regulated industry, you have more complications in transactions. To go beyond 15% in any company, we would have to go in on Hart-Scott-Rodino. I mean, there's a lot of rules as you increase your ownership. Obviously, almost anything we own, we'd like to own more of. It's fair to say that anything that we own, we like. There's very few stocks that we own, and I look at them as part ownerships in businesses. There's very few that are selling at some price where I would sell them a little higher. Well, I won't give them any advice specifically on what's target, but it's absolutely true that we've sold down our position. Some of it was sold down to avoid being over 10%, because then you do have some filings with the Fed and so on. But
They've sold well more than that.
Yeah, we've sold well more than that. We sold Wells Fargo in the 4th quarter, and we sold it earlier. We don't want to give any advice on what we're doing, because I could change what I'm doing tomorrow. We talk about everything except we don't give stock advice. Generally speaking, but there are a lot of other variables too. But the banks are going to make more money if there are higher rates with a steeper curve. The curve is more important. In other words, the 10-year versus short-term rates may make more difference in the absolute level. But American banks have made very good money with very low interest rates. Around the world, if you look in the UK or Europe or Japan, even lower rates have made it pretty tough for banks. The returns on equity are not as high, and they have to use more leverage to even get the same returns, and I don't like that as well. The 10-year at 1.4%, that means you're paying 70 times earnings for something that can't increase its earnings for 10 years.
Okay,
Now,
if somebody
came to you with a stock and said, you know, this is a terrific stock. It sells at 70 times earnings. The earnings can't go up for 10 years. You'd say, well, explain that to me again.
Right.
But no, we've never seen a situation like this in the world, literally. I mean, you can go back and read Keynes, and you can read Adam Smith, and you can read, all the great ones. And they don't talk about negative interest rate. It never crossed their mind. With supply and demand, all these marginal costs. But brilliant economists never really anticipated that you would have negative. You've got 13 trillion or something like that worldwide at negative interest rates, and we don't know what that means. I mean, we've got a lot of people who can speculate what it means, but 10 years from now or 15 years from now, we'll look back and say, well, it's obvious what would happen under that, and we'll see it. But it is not a normal situation, and well, interest rates are the basis of all value. I mean, if you knew interest rates were going to be zero for 100 years, you would think 1% was a great rate of return. But you also would know if you bought something that was yielding 1%, or that was what it paid, and rates went to 8%, you'd lose practically all your capital. So it's an enormous factor, and we don't know the answer. Central banks don't know the answer. All we know is that it's been useful in stimulating things, and particularly asset prices, now for 10 years. And what we thought was temporary in 2008 and 9 in the way of monetary policy to stimulate, we've just put our foot on the gas even further. The whole world has. It's bad for insurance companies, but it's good for stocks. Ones that really get hurt on it are either life or annuity companies that have promised returns. The property casualty business doesn't promise returns. It still holds money, so it hurts them. But if you promise somebody an annuity that's going to pay them 3 or 4%, and now you find that you're reinvesting your money at 1% or something, you're going to disappear. Well, they shouldn't. I mean, the answer, if you need to get 3% and you're only getting 1%, the answer is to quit giving 3%. It's not to try and get the 1 up to 3 and do more dangerous things. You should always adapt your consumption to your income. You shouldn't try and adjust your income to your consumption. That's a basic principle for individuals, businesses, and everything else. And reaching for yield is really stupid, but it's very human. I mean, and I understand it. And people say, well, I saved all this money all my life, and now I can only get 1% out. What do I do? The answer is you learn to live on 1%, unfortunately. And you don't go and listen to some salesman come along and tell you, I've got some magic way to get you 5%.